It is FOMC day, and you know what that means. Every single trader out there is licking their lips because it's going to be very volatile over the next hour and some change. Why? Because in just 10 minutes, we will find out what the next decision from the Federal Reserve will be. Are they cutting rates? Are they staying paused? And then at 2:30, we're going to be watching the press conference live as Jerome Powell tells us what the future looks like from the Federal Reserve. Will he be hawkish? Will he be dovish? How will the markets respond? We'll cover all of that and a whole lot more in the show. And stick around because we got a special guest joining us for the first part of the show today. You do not want to miss a single second. If you enjoy the Investing Bros content, make sure to smash that like button now. If you're brand new, consider hitting that subscribe button at the end of the video. All right, let's go. Welcome, everybody. You guys can see in that bottom right corner a face you don't see that often, but we love having him here when he is here. Stocks with Josh is joining for the first part of the show today. He does have to go at about 2:15, 2:20, but I'm so excited to get him on here for the first little bit of the show today. Josh, how are you doing today, my friend?
First of all, I love this show. I love everything you guys are doing, and I consider it such a privilege to be invited on today. And today, you and I know that it's going to be fireworks on Wall Street, and I'm super pumped. Directly after I get off this live, I'm going to go live trade the reaction to what the Fed says. And I can tell you that you're getting my prime thoughts on the day because I've got a lot that I want to share with you and your audience about where I think we're at in this current local bull move. Is it coming to an end today, or are we definitely going to chop higher? I've got really strong opinions on it, and I can't wait to share them.
I am very, very excited. Again, a lot of people listening right now probably already follow you, Josh. But to those who do not follow Josh, if this is maybe the first time you've ever seen his face, highly encourage you guys to go subscribe right now to Stocks with Josh. Let's show Tshroom screen here for a second so you guys can see his channel. Just a world of alpha, amazing technical analysis, great discussions on the stock market and crypto as well. Are you at 150,000 subscribers now? You just continue to blaze to the upside with no stop. You guys all need to go subscribe to him to get his take as well. Don't leave the bros, right? Watch our stuff as well, but you need to see diverse opinions. And I can't think of a second better person to go watch his show than Stocks with Josh. So go subscribe as soon as this is over. Before we get into the content though, because I had a lot of questions for Josh, I got to ask my man Tshroom. Tshroom, how you doing today, my friend?
Well, I'm better than I deserve, Tim. I really am. And I'm excited to chat with Josh about the future of the markets for this week and for months to come. He says he's got a hot take, and I'm really excited to hear it.
Absolutely. Before we get into the conversation, want to set the stage once again. Thank you, everybody, for being here. Smash that like button if you're just jumping in here. Today is FOMC day. If you're wondering why the bros are early, like an hour or 10 minutes early live, it's because we're covering the FOMC. Here in 5 minutes, we will find out the decision from Jerome Powell and from the Fed on what they're planning to do. I'll go ahead and tease my prediction on that one. The rates are going to stay paused. Every inclination is saying they're going to stay paused. What's going to be more interesting, though, and want to get Tshroom's opinion, Josh's opinion, you'll hear my opinion. How will Jerome Powell present himself at the 2:30 live press conference? What will the markets do in response to that? Before we get into our conversation and give some of our predictions, I got to throw it to Tshroom to break down some big stories you need to be taking in and holding accountable right now when you're looking at the charts along with the FOMC meetings. And it has to do a lot with the conversation we've been talking about now for 4 months, tariffs. We have more tariff news. Tshroom, go ahead and take it away. What's happening in the news today?
Absolutely. It's 6:30 p.m. yesterday. We got this headline. China confirms plans to begin trade negotiations with the United States. This is a very big and hotly anticipated headline, but it doesn't stop there. Also got a China stimmy update. So the People's Bank of China to cut reserve requirement ratio by 0.5 and also cut 7-day reverse repo rate to 1.4 from 1.5. Now, I can quickly interpret that as They are stimulating their economy through their central bank. Those are the biggest headlines, and they both have to do with China.
Yeah. And a lot of times I go ahead and give my take here, but I'm very excited to have Josh on the show with us. Josh, I don't even want to give my take at the moment. Maybe if you say something that I have a agreement or disagreement with, I'll chime in. But from your perspective, I want you to lay out what you're doing with this news, with what's going on with China right now, because in the crypto markets, we mostly talk crypto here. We recently have made a lot of moves that have made us probably more medium and long-term bullish. But I've heard with talking, through the grapevine that a lot of people who seem to be more Wall Street stock market focused, they still have some pretty major concerns. Does this news make stock market traders bullish, bearish, neutral? How are you interpreting this China news coming out?
Okay, well, so I want to just sort of take a step back and talk about what you're asking. We have bullishness and bearishness sort of swashing around like a ping pong being knocked back and forth on the table. And what's important is we have to define the time frame. Now, I have, and I'm going to be out on a limb, and I don't have to be right. This is how I'm looking at the market, but largely being a chart guy, I do follow the charts. I can guess and speculate which direction things will go, but at the end of the day, I only put my money at risk once I see the candle do what I was expecting or hoping it to do. And if it doesn't do that, well, I just hold on to my money and I wait for it to do what it's going to do. So take everything that I say today with that view that I'm going to follow the charts after I get off this video. So what do I think is going to happen? First of all, I'm going to give you my entire year in review as to what I think is going to happen on Wall Street. Okay. Ever since we got oversold, correction on the S&P 500, we got a full-blown bear market on the NASDAQ, and we got a recessionary pullback on the Magnificent Seven, greater than 35% when it got oversold. Ever since then, we have been slowly moving higher. Now, we created a pivot low. Now we have to flush out the end of the pivot high. And I don't think that that's going to be a return to all-time highs. I think that we're going to chop in this range, eventually get a pivot high, and then we're going to go back and retest the lows of the year. Okay, now let me give you the exact time frame. I've been saying that we were going to chop higher between now and all the way to maybe the first week in June. So all the month of May, we're going to have some pullbacks, but ultimately be chopping higher until a definitive pivot high is made. And I don't believe we've made that pivot high yet. So in the summer, from sometime in June to the end of summer, we're going to see distribution, sideways movement. In this environment, you're going to see some stocks reach new highs or even go back to all-time highs, and some are going to fluctuate. So let's call this summer a sideways volatile market, right? And then in the third quarter, we're going to go back and retest the very lows, but I don't believe that we'll exceed them by much. I believe that we will maybe get a lower low, and then into the fourth quarter and the remainder of the year, we're going to melt up and drift higher. And the end result is going to largely be a sideways year. This is not the Armageddon, and this is not the recession, because we're actually still dealing with a lot of money in the system and a Fed who's really will cut at some point and begin to put liquidity back in, and a president that's going to work out some trade deals. And so I've been saying that the risk is on the bears. And somebody asked me, what does that mean, Josh? The risk is on the bears. When you've already tested the lows, you've already gotten oversold, and you're sort of halfway to back testing resistance. What's resistance on the S&P 500? Resistance is probably 570 to 575. On Bitcoin, it's probably right under that 100,000. Okay, so those are some significant areas of resistance for both stocks and crypto. We haven't fully tested them. Now, when will we test them? We'll test them as soon as Donald Trump gives us some big news, right? The markets, it's going to be all about China. All the rest of the countries of the world matter, but the one that really will bring stability is the China deal. And the fact that they're now talking in Switzerland, and they don't even need anything solved. They don't need any outcome. They just need the surcharges to be dropped, and they need an environment of confirmed de-escalation. Something like, we had great talks, we're going to go into a period of calm. And if they can go into a period of calm, then Wall Street can go into a period of calm. So here's it one more time. Up May to part of June, sideways summer, third quarter decline, fourth quarter melt up. That's your whole year. Now, if you don't mind, let me quickly jump on my thoughts for the Fed. I think that, and I'll
let me pause you real quick, Josh. Let me pause real quick because we just want to announce breaking. I want you to continue. I apologize. It's 2:01. For anyone who didn't see it, it came out. The Fed did pause all interest rates, right? So no cut, no raise. We're staying at 4.5%. Not that that's breaking the world. Everyone knew that was going to happen. I think there are some people out there predicting a rate cut, but Jerome Powell's been telling us he's going to stay paused. The question is going to be here in 30 minutes. Stay around with us. I cannot wait to get back into Josh's thoughts here because this is really good stuff. If Josh is going to have to leave in 20 minutes, stick around with us, though, because we will be covering Jerome Powell live and seeing how he answers questions. That's going to be the biggest part of how the charts are affected. With that said, though, smash that like button, throwing it back to Josh because Josh is laying on some pretty great alpha for you guys. I want him to continue.
All right, so I wanted to cover how I think the Fed talk will go today. And again, I'm speculating. I'll follow the charts. If my view is wrong, well, then I didn't read it wrong. But I do have a strong view. So I think that the only power, so catch me on this, the only power that the Fed has really at this moment, he's got two arrows that he can fire, right? And one of them is the arrow he's been on. It's the sword he's been holding, and that's his hawkish stance. So being hawkish empowers him. And I'm going to break that down for you in a minute. To give up that sword leaves him with only one sword. And he likes to have two swords, or if we want to use gun analogy, he wants to go into the gunfight with two guns. Two is better than one. The very minute he lets go of his hawkish position, in a weird way, he is sort of admitting some form of market weakness, some form of defeat. Now we have to react to a problem. If he leaves the environment hawkish, and then he's constantly telling the market, we're fine. Inflation is the biggest concern, not slowdown. As long as he says no slowdown, that means no recession. It means that we just have to chop through these difficult days, let Donald Trump, get the deals worked out. Being hawkish buys everybody time, him, us, and Donald Trump. And so he's not going to give that up very easily. Now, Wall Street wants him to acknowledge that there are problems, and they're going to press him. They're going to say, look at that ADP report. Look at the GDP, man. This thing is on fire. You better start easing. So they're going to press him hard, and he's going to be like totally cool. Like, it's fine, guys. I'm concerned about inflation. We're monitoring it. He's going to play it cool, and he needs to hold on to that other pistol, because the very minute he lays it down, he's only got one tool, which is cut, save the economy. And then that's going to give more power to the bears. So believe it or not, as much as we might want him to come out dovish today and give the market a little boost, in my opinion, and that could give us a local continuation, overall, the better position for him to take is to remain hawkish. And so I see today as having the opportunity for a pullback, okay? Because I think the market's going to respond to the Fed being hawkish with bearishness, and he's going to respond to the President Trump giving us actual results, not just talk. And those are the things that are going to cause the market to pop. So real quick, I'm going to go over it. Inflation, still a problem. It's not dead. The job markets, believe it or not, may still be too strong because people don't want to let go of their employees right now because the borders are getting shut and there are less people in the building to employ. So they're afraid of letting go of important talent. So the job market is actually not falling apart the way some people fear. We do not have big tech dumping employees. The markets, believe it or not, even though they've pulled back, they're still hot. And I know that your audience might get angry with me. Bitcoin's hot. It's up at an elevated price level. It's not dying. It's incredible how strong Bitcoin is. You see Sui back on the move, right? Doing great. The fact is we still have huge global risk. Okay, so that's a problem for him. And so I ultimately, just concluding it, I think he's going to be hawkish, and I don't think the markets are going to like it, and it's going to lend for a volatile day. Now, I said on Monday, that he'd come out hawkish, the markets would drop. Friday, they would announce some news relating to trade deals, the market would pop. So this is going to be a volatile week.
Yeah, I 100% agree with what you just said right there. In fact, we'll kind of get to the prediction side. I want Tshroom to give his predictions. I'm going to give my predictions. I'm going to sound like a parrot though. 100% I agree with you. I mean, why am I agreeing with you? Recently, even though inflation numbers look good, what are they not? They're not 2%. Jerome Powell's been very emphatic. 2% is still the goal. He's not releasing that goal. The only reason he would give that goal up is if unemployment starts to look like it's out of control. And while it is technically trending slightly upwards, we just got the most recent unemployment data that came in just as expected. It's not out of control. And this gives him the freedom, the ability to stay paused for longer, as he's been saying for the last couple of meetings. I think a lot of people are clinging or were clinging to this thought that he was going to cut rates today. I think some people are clinging to this thought that he's going to come out and say, we might be closer to cuts than we think. But I'm on the same page right now as Josh. I think he's going to come out hawkish. I think the markets will pull back. We've been monitoring here on the channel. The charts have been telling us I'm medium term, long term bullish on Bitcoin. Short term, though, we really have been overbought, just like Josh said. We're going to do charts here in just a couple of minutes after Josh leaves. But we've been talking about now for over a week. The 12-hour chart has been telling us we want to pull back down towards 90,000. We have a CME gap down there as well. And so even though I'm not predicting new lows for Bitcoin, I think we're putting in higher lows here in a little bit. I agree with Josh 100%. This is a time to cool off after today. And then guess what? Whether you believe in news-driven markets or chart-driven markets, it will revisit a short-term oversold position. Whales will buy it up. The composite man will buy it up. We'll go back to the upside. This isn't the end of this rally, but it is something to prepare yourself for. This could be the catalyst here today that brings us down. I want to say that. I'm going to throw it to Tshroom here in a second, give his take, because I think he has a slightly contrarian take to that. All of that is assuming that he comes out hawkish. And I'm sure Josh agrees with this. If he comes out and surprises us and says something along the lines of, hey, we stayed paused for today, but honestly, the news we're seeing come out of the tariffs are actually very bullish. We're not as concerned about inflation. We believe we can start a slow but sure process of cutting rates starting in June. If that happens, all right, we might go ahead and shoot up here today. That's just not what I'm expecting. However, I want to throw it to Tshroom because he might have a slightly different take than me and Josh, and it's good to have different opinions thrown at you. Tshroom, what are you thinking?
Yeah, well, after I've been reading the statement, so they put out the decision, and they also put out a revised statement. I have to say that I was going to make the case that he's going to come out a little bit more dovish, and I'll still try to make that case. I'll play the devil's advocate here. But after reading some of the red lines here, it's harder to see that picture. Let me briefly show you what I mean. So Zero Hedge tweets it out. FOMC red line. Only notable change is mentioning the mention of risks of higher unemployment and higher inflation. Also mention of swings in net exports, which, however, are dismissed as economic activity has continued to expand at a solid pace. So highlighting the two mandates of the Fed, the question is which one is going to spike faster? Which one will the Fed need to attend to? If I'm Jerome Powell, what he did today makes a lot of sense because he doesn't want to start attacking a number before it gets out of hand and then risk the other number getting out of hand, and he's already initiated that momentum. Now, let me paint that dovish story because there's a backdrop here and there's some pressures that didn't exist just 2 days ago. The People's Bank of China just announced some pretty significant stimulus, which is a continuation of stimulus that we've seen earlier in the spring. Since January, China has been very aggressive in trying to stimulate their economy. The dovish case would just be that Jerome is looking across at his peers, other central bankers, and says, look, this is the trend. This is what needs to happen. Canada's done it. The EU's already cutting. And now China is continuing their stimulus policy. So, maybe I get in line with the other central banks. Maybe this is the time that I do that. And obviously he can't go back and change the decision. So when I say that, his verbiage, what he's about to say in the press briefer, signals that June and July are going to be cuts. Again, I hold very, very weakly to that theory. In fact, I wouldn't be surprised if he does come out pretty hawkish, just taking the dove side.
Yeah. Absolutely. I see in the chat, before we throw it back over to Josh, some breaking news, and I don't know where he's speaking or what he's doing, but there is some news coming out from Donald Trump saying that he is not open to removing 145% tariffs on China. Now, I know Tshroom reported earlier, the negotiation process starts on Saturday. What this is referencing, I'm not 100% sure about. He's talking about right now, is he saying, I'm not going to do it unless there's a good deal? We know he said the other day that he wants a fair deal with China. He's going to offer a fair deal. What does that mean? That is open to interpretation. But the charts aren't necessarily going to love this. We did just moments ago on Bitcoin drop briefly below 96,000. We're back above right now. But one thing we know, well, we can't tell you 100%. Josh can't tell you, Tshroom can't tell you, I can't tell you 100% which way the markets are going. What I can tell you with a lot of certainty is strap in, because the next hour is going to be volatile. Powell will say things that make the markets go up. Powell will say things that make the markets go down. There's ultimately a lot of playing around that more experienced traders are doing. So you want to be very aware of key resistance and support levels and what's the overall trend here. But this is some news that we're processing here only moments ago. Josh, anything you want to add to your take or anything responding to something me or Tshroom said here in the last 5 minutes or so?
Well, no, I enjoyed both of what you guys said. And I think today the markets are going to get disciplined by Fed Jerome Powell. He has to maintain sort of this corrective mode about what can or can't be done. I think he's actually going to be anchoring expectations. I think that's the mission that he has, is to come out and anchor expectations. And I think the market's not going to love it. I think basically why would he do that? Because he's guarding against future risk. He's looking further down the road than we are on a situation that could get more out of control, which is a raging inflation and a declining economy, right? And so he's rather going to hedge it today and anchor everybody's expectation to caution rather than to give the market what it wants in the time being. He has no motivation to do that. So I think all I wanted to say was just to reiterate why we're going to get a hawkish Fed, because I don't see what it is he has to gain. It goes back to the two-pistol fight. He's simply going to get one shot out of his hand, and now he's underarmed for the battle.
100%. I agree with that analogy. It's going to be fun to watch how this press conference goes in about 15 minutes. While we still have you, we have you for just a couple more minutes, then we're going to let you go. Josh is going to do some live trading with his community in a little bit, so he's not going to stay with us. Again, if you guys are just joining and you have never seen this man, a beautiful looking blonde man right here, his name is Josh, and he has a channel called Stocks with Josh. If you're not subscribed to it and you don't watch his content, you are missing out. Go subscribe. The link is in the description right now. Josh, I always love getting to talk with you. You have more of a background in the stock world. I have more of the background in the crypto world, but I love getting your take on crypto because it helps open my eyes to things that I'm not even processing. What are you kind of feeling right now about altcoins? And what are some altcoins sticking out to you in altcoin season in general? Sorry.
Thank you for asking. I wanted to share some thoughts on my view of Bitcoin and the alts. So we're seeing the alts. So let's imagine the alts, or some of the best alts, are sort of like the Mag 7 and Bitcoin sort of like the index or something along those lines. The point is that we're beginning to see the alts come up off of their bottoms the same way we saw companies like Apple and Amazon come up off their bottom. And I think that they also need to have a pivot high and have some time. I still see this period because I don't even view the summer as a summer of decline. I view us as chopping higher. Today could be an ugly pullback day, but ultimately we chop higher through the month of May and some portion of June. And then we go sideways. Because of that, I've been saying that it's advantageous to buy pullbacks on projects that you are more confident in, pullbacks on your favorite altcoins, because I think that they're going to eventually get into a classic phase of distribution come summer. So ultimately, I see higher highs from here. Not today. So let me give you the scenario that I view for today. Today, if Bitcoin loses 91,000 to 92,000, if it can't hold that position by the end of today, it has to go back as low as 86K. A huge level of support there that was well tested over the last first quarter of this year. Well-established zone right there. It'll come back and it'll bounce. That's where I would be looking to re-enter on and to take bigger positions on that pullback. So if you see Bitcoin hit 86, you go to your favorite alt and you take a little bite. And I think that that'll be what's called resetting momentum. We'll have a full momentum reset for that continued chop higher. So not expecting the market to go bullish today, but anything could happen. It wouldn't change anything I just gave you. I ultimately think that we're going to see the markets come back and reset momentum. Bitcoin could hold that level I mentioned. It could hold it. But I kind of suspect that it won't. And if it doesn't, it's going to pull the alts down with it. And you want to look at re-entering those positions at around that 86K for that continued chop higher and that eventual pivot high and that eventual summer of distribution. That's my view.
Yeah, I think what our levels we've talked about are a little bit higher than that. We've monitored 90,000 is going to be very interesting, and then 89,000 is going to be very interesting. But 86, I see where you're getting that one. I'm purchasing probably a little bit higher than that. But hey, guess what I'm going to do? People always ask, like when I give these levels and it doesn't stop where I have support. You know that there's a thing, everybody out there, called a stop loss. And so like what my strategy is I buy at a level, but put in a good stop loss so that if I'm wrong, which I'm wrong frequently, right? If I'm wrong, that's okay. I'll go to the next support level and then buy at that level. And if that support level is wrong, I'll get a stop loss and buy at the next support level. So while Josh and I might disagree about $86,000, there's a part of me, Josh, that I really hope you're right, because I would love to buy some more Bitcoin at $86,000. I would love to buy some altcoins at much cheaper levels. That you're absolutely right. Altcoins are not going to stay where they are if Bitcoin falls back below 90,000. That's just not going to happen. Altcoins are going to drop. And I'm in a case the other day. I'm interested in your thought here, Josh, and I'll be brief because I know you got to go in a second. I made a video the other day that got a lot of views, but I think I pissed a lot of people off where I said that altcoin season is going to take some time. I still believe an altcoin season is coming, but it's going to take time. And the reason for that is that Bitcoin, I think, is slowly but surely actually being treated the way that a lot of us view it, and that is digital gold. It's a place to lock up your value and hedge against inflation or against problem times. But altcoins, they're the future of technology. And until we get liquidity coming back in, you talked about it when you're talking about the stock market, like Apple and other technology stocks, I think it's going to take a little longer for altcoins to go berserk like they did back in early 2021, because they're going to be waiting on things like the Fed to cut rates and liquidity to come back in. I'm interested. Do you agree with that take, or do you think that altcoins could have a really special summer different than the stock market?
So if I've done a good job of explaining the way I view this upcoming market, and if Bitcoin does, like the NASDAQ, peak out sometime in the first part of June, I believe that it would then lend itself to what we would view as the altcoin rally, which would be in that distribution phase in the summer. So if we're going to have a beautiful alt season move, in my prediction, our final opportunity for that will be this summer, June, July, and August. Some portion of those months, we're going to see the altcoins do their thing. And if it doesn't happen by then we need to take some serious timeline of the bull move into consideration. And, I'll make more predictions about that later. So alt season is this summer, do or die, pop or drop.
Very interesting. Josh, I have like 27 more questions for you, but I know you need to go. Thank you so much for being here. Cannot wait to get you on again, get your thoughts on the markets as a whole. Once again, if you guys are just joining and you guys are enjoying this content, make sure you're subscribed to this channel here at Investing Bros. Make sure you're subscribed to Stocks with Josh. We're going to be staying live here. We're going to be covering everything, but Josh has got to go. Josh, thank you for being here, man. We'll talk again soon.
Thank you. It was such a privilege, and I enjoyed it. I look forward to the next time we talk.
Absolutely.
Peace.
Guys, go to the description right now. Go subscribe to Stocks with Josh. All right. It is 2:20. 10 minutes, Tshroom, until we get the live press conference. By the way, are we good? Smay is in the background today. He took a back seat so that Josh came on camera. Smay, we have the link, and we're good to go. Everything's okay. Sweet. Very good. It's time to jump into some charts. Before we do, Tshroom, anything you want to kind of talk through real quickly? You're wrapping up having Josh on here. Loved having him on here. Had some very I have some thoughts I agree with. Some of the thoughts I'm maybe not on complete board with. I think it's very interesting that he thinks that the altcoin season has to happen this summer. I have it in my analysis coming actually later. I think there's a chance we don't get an altcoin season until after summer. But how did you process what he said right there? Did that make sense to you? Do you kind of get on board with that kind of a prediction there?
I mean, he gave a short-term bullish prediction, and then we kind of trade sideways, and then until we don't. And when we don't, his prediction is that we'll move quite a bit higher into melt up into Q4. I don't have any reason to really doubt that. I think that there's a lot of wins that the market can see as we get deal after deal after deal and tariffs are removed, right? So Donald Trump was asked, I believe it was yesterday, a journalist asked, where are the deals? When are we going to sign the deals? He said, I'm not worried about signing the deals. It's not about the signing the deals. They'll come. We could have 100 of them in the same day. He's worried about other things. So I think that kind of signals to me that there's a lot of bullish dopamine hits that are on the horizon, and the stock market and risk markets in general love nothing more than good news that could come in the future. So I think Donald Trump, call him a genius, call him accidentally good at this. He has set up the markets for quite an aggressive V-shaped recovery here. I'm talking about equities and crypto, and we're already seeing it in Bitcoin. Can it hold some of these levels and push higher? Really is the question. I don't have a whole lot to disagree with Josh. It's honestly a pretty exciting picture.
Speaking of, we're not going to go into a lot of detail here, but the president did say yesterday that there's a major announcement coming very soon that has nothing to do with trade, but supposedly we've been waiting for it. It's going to be amazing. Here's the deal. There is the part of me that says I really hope it's big. Trump and his administration have had a record in the last 4 months of overhyping something that's not end up being a big deal. The markets pump in anticipation, then fall back when it ends up being a nothing burger. I'm going to continue to wish that something good's going to happen. Why? Because I want to make money. I want you guys to make money. But I am also not going to hold my breath at this point. I want to see what it is before I make any kind of big financial decisions there.
And real quick, there was a tweet that went out a little bit earlier at 1:15 Eastern from Zero Hedge. This could have been the announcement. I'm not sure, but Trump administration to announce U.S. will call Persian Gulf the Arabian Gulf during Middle East visit per CNBC. So there's a chance that that's the announcement. That would be a pretty big announcement at the geopolitical level. Has very little consequences when it comes to America. The market. We could break that down. I did look into why that's significant.
Something he said, and the reason I don't think I see it, because he said it's something that's going to be very good for the American people and something the American people have been waiting for.
Okay.
Put a 1 in chat if you even knew that possibility was on the table, if you've been waiting on it. I don't think we're going to get a lot of ones here. Put a 2 if you had no idea that was even. If that is the news, Tshroom, very disappointing, right?
Very disappointing.
Oversold, and then that's terrible. I would be surprised if that was the news. But let's get into charts here. We have a couple of minutes before we get going. I'm going to tell you guys what we're kind of watching right now. I'm considering, I'm not sure right now. Go to my screen here, Smay. I'm considering, based off of the predictions that I made earlier that Josh was talking about, him and I are in agreement here. I think there's going to be some blue candles coming down. With that said, there's a beginning of one right now on the 12-hour chart. We're still looking at sell signals in play with smart trails on the 12-hour chart here back down towards 91,000. I talked about that earlier. That's going to be where I'm making some additional buys to my longer-term longs on Bitcoin. Josh mentioned 86,000. He's talking about the highs we had back here around April 14th. I don't think that's ridiculous. I don't think we're going to get that low. I think that the $91,000 and the $89,000 supports that we have in play from the 12-hour and the daily smart trail would make a lot of sense to me to hold up. But once again, as I just told you, if I was trading this, like let's say right now, I'm going to talk about how I might want to short this, but let's say I was doing longs, I probably will set up a long here on 91.5, give or take, and I'll have the take profit way to the upside. I'll probably put my stop loss pretty safe here, right around 90,000. If we lose 90,000, I'll set up another long somewhere down here just above 89,000, right? So I'll put the take profit way up here, and then I'll probably put my stop loss somewhere here in the realm of 87. Then if we lose that one, guess what? I'll come down here and I'll buy at 86 and I'll take this one. And you know what's crazy here is people are going to say, Tim, you're going to lose this trade. Just look at this, for example. If this is my trade setup, like this isn't the exact detail here, but I would be risking 1.63%. I'll lose 1.63% of my trade, then maybe 2%. So let's just do a total of 4%. And then I enter this one. If this one ends up being right, if this does take us with Bitcoin back up and goes towards new all-time highs, maybe let's just go to 110, right? Let's go to 110 here. We're talking about a 28% move to the upside. 28 take away 4, that's still a 24% move. This is a very good strategy in trading. This is going to be kind of how I'm going to be treating the next couple of days with longer-term trades. If you want to have more details, when I'm entering, what I'm looking at, VIP Trading Group is the route for you. We're talking trades every single day. We've been crushing it over there over the last couple of weeks. In a nutshell right now, what I'm more focused on in the short positions, though, is that 12-hour sell that is still in order here from Luxago. The fact that the daily is not an official sell signal, and right now we're actually seeing a green dot. But if we start to make negative moves here, don't be surprised to see that green dot go away, see the money flow start to go negative. You do see already the MACD is on the verge of crossing bearish here for the first time since back here in early April. If that happens, the RSI is oversold. There technically is some bearish divergence here where we put in a slightly higher high but lower highs in the oscillator. There's reasons to be negative. And then you add that with the negativity on the charts, with the fact that my expectation is that Jerome Powell will be bearish here. He will be hawkish is another term that people use. A lot of animal phrases get used in the world of investing and trading. My anticipation is there's going to be a sell-off here. We've been talking about a pullback now for a while. This is not bearish. Again, let's even pretend, for example, again, I think 91 or 89 is the reasonable level. Let's say Josh is right, and we do get a pullback all the way back down to 86,000 area, and then we bounce. That's still a much higher low than what we recently went to. This is still a bullish formation. This is a part of bull rallies that happen. If you go back and you take a look at what happened last fall, we had a very long, very bearish summer. We came down, finally bottomed out around $52,000, made some moves to the upside. It wasn't a straight shot from $52,000 all the way up to $100,000. Right? There's a lot of volatile moves that happened. And if you look at it, guess where we had some volatility pull back to here in September, October? It pulled back down to the daily smart trail, which right now, again, is coming in between $90,000 to $89,000. That's the level we're watching right now for support right there. So that's where I'm going to continue to believe. I think that that's where the support can come in again. I am still long-term bullish. I still believe after this pullback, if I can grab the marker correctly, after this pullback, Josh said the same thing. We should see a move to the upside. Now, what I'm curious to find out, I always forget to ask him this question because he says it several times. He said a melt up, Tshroom. Does melt up have a definition to it? Does melt up mean slow but steady? Or does it mean really fast and really, like, I don't know what melt up means. Anyone in chat, are you familiar with the term melt up? Let me know what that means.
I hear it as slow and steady. I think
I would imagine slow and steady.
Yeah, with periods of melt your face, but because that word, that's also a word that you could.
That's what's throwing me off. Is melt could be used as an extreme, but melt up would the expression just sounds very slow, right?
Think about it like this: like right now, the Fed doesn't have a reason to cut when they look at the unemployment rate, right? When they look at the GDP, yeah, perhaps. We could see the beginnings of unemployment rates starting to get a little bit out of control, and inflation either stays where it is now or only moves up, 0.5 basis points. The reality is at that point in time, that's when the Fed doesn't have a choice but to cut. That's when they have to act on their mandate. Now, what would contribute to the unemployment? I'm not exactly sure, but the conditions currently are not creating high unemployment. So something would need to change in the future, and that could create that melt up. If you think about AI and its impact, we might see some acceleration of AI technology that unemploys people in the second half of the year. That could be congruent.
Yeah, I'm putting a poll in chat because even as I'm reading chat engaged, chat's pretty split here. I'm going to put a poll for everyone to vote. Slow and steady. All right, go vote on this poll right now. What does melt up mean? Because some of you are saying very fast. Some of you are saying slow and steady. It would make more sense to me to be slow and steady. But again, I'm open to what you guys think here. With that said, it's 2:30, which means Jerome Powell is either at the stage or on his way up. Smay, can we get a quick look at the cam? Okay.
He's not there.
You're just going to chime in when he is. Okay, let's just keep it right there. We are going to be watching this. Oop, did not mean to have that marker on. We are going to be watching this on Bitcoin. I might flip to some other charts, but we'll keep you posted. Let's turn that sound on. Here comes Jerome Powell. Smash the like button.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile, there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out, and also when they do settle out, what will be the implications for the economy, for growth, and for employment. I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think if you look where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago, labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And, you know, we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
You know, as I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And you know, when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and you know, as that develops. And I can't really give you a time frame on that.
John L.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, I mean, so let's look back and see where we are. So to go through 2024 up to the day, we've had you know, unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we would never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, you know, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got you know, forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby.
Opie Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. Yeah, we're not in this situation, but the situation is if the two goals are in tension, so let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. We haven't faced that question in a very long time. So, again, difficult judgment to make, and not one that we face today, and we may never face it, but we have to be keeping it in our thinking now.
Edward.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
It's going to depend. I think you have to just take a step back and realize this is why we are where we are, is, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't. And we just don't know. Open. Until we know more about how this is going to settle out and what the economic implications are for employment, for inflation, I couldn't confidently say that I know what the appropriate path will be.
So following on that, so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks. And that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen. But they haven't materialized yet. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And usually things clarify and that the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also, there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that. But in the meantime, yes, we're watching it extremely carefully, like everyone is, but don't see really much evidence of it in actual economic data yet. And by the way, consumers keep spending, credit card spending. It's it's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again?
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. Look, I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we of course tapered and everything. And then we made
about in 2022, I guess.
And we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential. And we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network for greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not on your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, wanted to hear it that way. But that's not at all what we meant. So that's just not a correct reading of our. But I can see how maybe people found that confusing, and we have to take that into consideration.
Jolene.
Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses big and small are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Higher unemployment.
So we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. So they're worried now about inflation. They're worried about a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there will be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. People are not layoffs, or people are not getting laid off at high levels. Initial claims for unemployment are not increasing, in any kind of impressive way. So the economy itself is still, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Chris.
He does not want to talk Trump at all.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, what kind of interest rate decisions you will make later this year. So does that, in March, there was guidance that 2 cuts might happen. 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
We don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. And we don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we had the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. It could include us holding where we are. We just are going to need to see, how things play out before we make those decisions.
Great. And just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the two goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other, and if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension, but if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. I think what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
We don't give Congress fiscal advice. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path.
Good
and
distinction.
It's on Congress to figure out how to get us back on a sustainable path, and it's not up to us to give them advice.
Well, do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Got him.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I mean, I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
Yeah, I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Claire.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic-era shortages and higher prices if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. But what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, I mean, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly?
I don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is, this is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods increased significantly in the first quarter. Do you think that this situation could cause a delay in the impact of tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decision. So the volume of the imported goods increased significantly. So the impact on the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we I think we think that there was a big spike in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to usually positive. That's very likely as imports drop sharply. You could also have, very likely you'll have restatements of first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories, government, or inventories, government. Anyway, it's a cleaner read on private demand, but that too probably was flattered a little bit by by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to, I don't think it's going to affect our decisions. I will just say, though, that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economies. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is, we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses. And so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting. And so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right, though. We had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you're monitoring the shipping data, and we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else. And, right now we see inflation, kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now.
I voted for
to make the
Kamala.
right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night. And this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question. Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
Good question. He's just not going to
I've
answer.
never asked for a meeting with any president, and I never will. It's not. I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative. I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy. When it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
All right. What another amazing, entertaining, and useless FOMC meeting. And I was being facetious on the first couple. I'll say this. There's a couple things I have takeaway where I'll break down very quickly. But Tshroom, I think that went just about as I expected and predicted in the beginning of the show. Inflation's not at 2%. Unemployment data still says very clearly that it's not in trouble. I have a thought I would take about that, like the way he responded to questions. But ultimately, I wouldn't call this like hawkish, but it leaned hawkish instead of dovish for sure. You guys can see when I was doing the charts, I entered a short. We pretty much caught that short perfectly. I didn't know how perfect it was going to get caught. If you go to my chart here real quickly, Smay, let's talk about that. What I saw, why did I enter the short at 86.87? I saw that smart trail on the 50-minute chart. This was the highest buy signal that I saw from Luxalgo, and therefore that's what was my trigger. Could we get some volatility here and bounce back up again? We absolutely could. While we were live here, I was drawing. There's a small symmetrical triangle on the 5-minute chart being played out. This is going to take some time. I would expect this trade to take a day or a couple of days to play out. But what I did do, if you zoom out to larger levels, I'm just thinking what happened today was kind of what we needed to happen for that short all the way down back towards 91,000. I might raise it to 91.5 depending on some different details and different things. If you got here the 12-hour chart, but I put my stop loss at 98K just in case. If we set a new higher high for this whole section, I want out of the trade. I want to reevaluate. But as a whole, that meeting went the way I expected. And I told you guys in the pre-show, if it did come out that way, I was going to look for a short position. At the moment, it looks like we have a very good short position. I'll keep you guys posted if you're in the VIP trading group on how that trade is going. If you're not in the VIP trading group and you love seeing and learning how to enter trades, this would be a great time to go ahead and enter it. Tshroom, I want to address some of the things that I thought were significant, and I want to throw it to you. So I have a couple things I wrote down here on my nice little note whiteboard. I still love to take notes by hand with all the computers I have in front of me. The first thing that really stuck out to me that I wanted to address, he agreed, and I'm speculating that he's talking about the 2022 phase because they didn't really say a date, but he agreed that 2022 quantitative easing lasted too long. This has been one of the major critiques that I have been making for years now about Jerome Powell. As a whole, I'm not as negative about Jerome Powell as maybe other crypto holders are. I think Jerome Powell, for the most part, has seemed to do his job, not get too political. A little bit more on that here in a second. Again, the key word there is too political, right? But there's definitely been moments he's been a little political. But I've always said one of the biggest mistakes he made was waiting as long as he did in 2022 to move into quantitative tightening. It was very clear inflation was out of control. Anyone who has a basic understanding of the economy and understands what we just had gone through prior with COVID and the shutdowns and everything else and the pumping money in, everybody understood inflation was coming and needs to be addressed. But there he was waiting on the data. And he said, listen, we made that mistake. We knew we weren't going to be perfect. This is the first time I've heard him address that and pretty much admit that they made a mistake by waiting as long as it did in 2022. Now, he kind of addressed the second part. I did see a chat in chat from, I think it was from Steady Bug. And he said, I would love for someone to ask him why he cut 50 basis points right before the election. And I kind of treated it back like, that's a good question. I don't think he's ever going to answer it. I don't think they're going to let people answer it or let people ask that question. They kind of did ask that question. Not that specifically and not that targeted, but he was asked, hey, at Jackson Hole last year, which in case people don't know, the Fed was in Jackson Hole at the end of August, right before the rate cuts that happened before the election. Why did you cut rates back then, but the unemployment was at the exact same level at 4.2% as it is right now? And I'll say this again, I've been a Jerome Powell defender. I wouldn't call it myself a supporter of his, but I've defended him. I did not like the way he answered that question, Tshroom. And his question, the way he pretty much said was the job market was in a different place last August. It really wasn't. He said that we had to show that we had to show the American people that we were considering unemployment was the gist of what he said. And again, you get to that level of, I've defended him that he does not get too political. Left or right, or he just doesn't seem to get too political. He doesn't like Trump. But he's also not necessarily taking advantage of times to go out against Trump, right? He just doesn't like to talk about Trump. It is very hard to rationalize the timing and the excuse of the 50 basis point cut that happened last, was it September, I think, September or October, whatever, right before election. As the election was back and forth, and one of the biggest critiques of the Democratic Party was that unemployment was going to be a problem. The economy was set to tumble. It was at 4.2%. And 4.2%, according to him right now, is at a very good level. Why did he cut rates? I hear that excuse. Oh, we had to show the people. No, you didn't. You didn't have to show the people. If 4.2 is not a big deal, you don't need to cut rates. If 4.2 is a big deal, then you should be cutting rates right now. So, again, am I the, do I hate Jerome Powell? Do I think he's the worst human to ever exist? I'm not saying any of that. I'm saying I didn't like the way he answered that. I didn't like the way he handled that expression. That to me was a slight move of maybe being a little too political, and I think he got caught up in that. Watch no one ever press that number, though. They're not going to let people ask questions to press those kind of details. Last thing, obviously, again, he just kept repeating the data does not show unemployment as being bad. That takes me back to the mistake he made in 2022 when the data didn't show inflation as being that bad. Although we all could understand mathematically inflation was going to get bad. And if what he's saying is true, I'm just going to track this, Tshroom, and I'm going to ask you and kind of get your feedback here. There's a little bit of an inconsistency with saying We're not certain about inflation, and tariffs and what's going to happen with tariffs could cause further inflation, which he's right about. But you know what else tariffs are going to do? Tariffs are also going to cause a spike in unemployment. That's just mathematically what's going to happen. Tariffs are going to cause higher inflation and a short-term spike in unemployment. Until we can get the infrastructure in the United States to build and manufacture things here, this will bring layoffs as the economy stumbles. To which case, in 2022, you had to wait for the data and didn't move till the data was there. But now the data is showing we should see a spike in both of them. It seems like you're making the same exact, after admitting that you should have cut rates sooner in 2022, even though the data didn't support it, it looks like you're possibly making the same mistake now, Jerome Powell and the Fed, talking to the whole group, in saying, well, the data doesn't show unemployment's in trouble yet. Well, the data didn't show inflation was in trouble in early 2022, even though we all knew it was going to be. So you're going to wait for a disastrous spike in unemployment? The same problem, if these tariffs are so bad that they're going to cause a potential rise in inflation, and you got to monitor that, wouldn't it also cause a spike in unemployment, in which case you should work to negate that and get ahead of it before it happens? I don't know. I have been a defender of Jerome Powell in the past. I think today there were a couple things that happened, Tshroom, that make me say, Jerome, you lost me on that one. That's a mistake. And you might be showing a little bit more of those political cards that you've been good at in the past of keeping hidden. What were some of your big takeaways from this, Tshroom?
I'll play the other side of that, right? If I was Jerome Powell and I heard that criticism, what I would say is, well, we did get ahead of it. We did a jumbo 50 basis point cut in September, followed by 2 subsequent cuts throughout the rest of 2024, right? So we did get ahead of it. We acted well before the data was present, and then the other thing would be, Tim, what you're describing is the forces that would create the bad data that I would have to act on. But the data isn't there. It's just the forces. So that would be his response. Yeah, I would love for him to cut. That's going to help my bottom line. At the end of the day, he doesn't care about my bottom line. He cares about what his mandate is. And to the extent that he, wants to have a political affiliation, that's another thing. But what I have written down on my notes is a little bit different, Tim, than I think what you had. It just says buy Bitcoin. That was my main takeaway. No, I jest. But if you jump over to my screen here, I do have some highlights that Zero Hedge pointed out. First of all, from our account, Jerome Powell's current term as chair of the Federal Reserve runs until May 2026. So he will not be the chair through May of 2026, but his term, just as a Fed governor in general, does not conclude until 2028. The beginning of 2028. So just a clarification there. I was a little bit caught off guard when the journalist said 2028, but the journalist was right. So
I'll tell you this right now. He's going to resign. Like, I guess it's not guaranteed, but I'm going to predict right now when he loses the chairman's seat here in 2026, he's going to step down. He's old. He doesn't. Here's the thing. He very clearly does not like Trump, right? 2028 would mean he runs all the way through the end of Trump's administration, and then he's done. That is a man that does not want to put up with Trump any longer than he has to. I think he has a sense of duty and responsibility in saying, this is my job, I'm going to see it through. His job ends in 2026. He can stay on. Don't be surprised when he resigns and says, I'm going to go play some golf. I'm going to go sit on a beach. I'm going to retire and not have to deal with this nonsense anymore. Again, I think he considers dealing with the Trump administration as nonsense. That's what I got out of that. He's not going to answer that question now. That's just how he is. Don't be surprised when he steps down in 2026.
Yeah. All right. Well, I'm going to give my take, but let me give you a couple more data points here from Zero Hedge. So he also said, you can go to my screen, uncertainty about the path of the economy is extremely elevated. That was something he highlighted a couple of times. We don't see big economic effects in the data yet. That's something we've talked about a little bit. Powell said, when things develop, we can move quickly as appropriate. When Doge fires 200,000 federal workers, that's kind of the undertone there from Zero Hedge. And that's it. So my overall thinking here is that Jerome Powell did what Jerome Powell does best. He played the middle of the line there for the doves and for the hawks. He gave a little bit to both sides. In my opinion, he came out of this a little bit on the hawkish side. A lot of people are going to point to the political bent and hesitance to answer certain questions. But I think he did what he's a master at, which is playing the middle of the line. We're going to wait for the data, and our situation. We are in a good situation, and when the data presents a conflict, we will fire our weapons at that conflict accordingly. And, as far as the Federal Reserve goes, that's a pretty good answer. And it's an answer that is going to just continue to benefit him because he doesn't have to necessarily take an action. Now, I want to give a little bit of a bullish spin to this, though, because if we just get pauses all through the rest of 2025, that's going to be a bummer for people, right? They're going to think, QE, where's QE? We're just going to stay in this kind of languishing QT. That's not going to be good for my altcoins. Not going to be good for me and my money. But let me pose this. As long as there is no conversation of rate hikes, right, and it's just pause after pause after pause, that is not necessarily the worst conditions for risk assets. Why? Because it does create a situation of certainty. Markets love certainty. What will end up happening if they just pause all the way through the end of 2025 is it means that also unemployment and inflation have really stayed intact. Inflation hasn't gone up, so they haven't had to hike. And also unemployment hasn't skyrocketed, so they haven't had to cut. So pauses all through the rest of 2025 is not necessarily a bad thing, in my opinion. And that is something that the market is more than likely going to start having to realize and reconcile with. So that's kind of the way that I would spin it from a bullish perspective, because as soon as that is understood and accepted by the market, that can allow asset prices to elevate on that foundation of we're just going to have these rates. 4.25 is going to be the rate that you have to pay to take out a loan, and that's it. And then the markets will recalibrate, and we'll move forward. And some stocks will lose, some stocks will win in that new situation.
I'll say with what you're talking through right now, let's pretend there's no rate cuts to the end of 2025. I think a lot of signs are pointing to your pull up your signing in. What note did you take? What was the big note of the day?
My big takeaway today, Tim, was buy Bitcoin. That was what
and that's a great takeaway. It's a great takeaway. And the reason why is because I do think we are watching the world transfer their processing of Bitcoin from a risk on asset, from a technology that you could potentially build wealth. They're moving it into this is where you stabilize your wealth. If we say pause the rest of the year, I could still see Bitcoin climbing and hitting new all-time highs, pushing, do we get to 200,000 by the end of the year with all that? Maybe not, but maybe getting closer to it, right? I could see that happening. Altcoins, no. And here's the reason why. Yes, they're not going to make it worse on us by cutting rates, but right now, the stock market is screaming at us. The altcoins are screaming at us. We need an injection of liquidity. We need new money to come in to invest. When there's no liquidity coming in, if you're not moving forward, you're really moving backwards. The economy is more on it's like a reverse treadmill. If you stand still, you're going to fall off the back of it, right? That's a normal treadmill, right? You got to be pushing forward to grow forward. And if they don't bring in liquidity, watch people in fear say, you know what? I don't like the dollar. I don't like fiat. But it's not time to go into risk on assets because they're not injecting liquidity. And I could invest right now and then lose a lot. I'm going to put my money in things that hold value. Historically, gold. Gold will benefit from the scenario you just said. And I believe the world is getting very close to treating Bitcoin like the digital gold that it actually is. I see a world in which that happens and Bitcoin is fine, gold is fine. But altcoins, I'm not saying they plunge. I'm not saying major bear market. I'm saying they get stagnant and don't do a lot. They need an injection of liquidity, and that's where I think rate cuts are going to be important. But I wanted to go back and respond to a different thing here. We're probably going to wrap up in a second. I think this is a pretty straightforward, clear-cut thing, but I want to go back to, again, kind of defending my point. Why do I dislike how Jerome Powell handled the data analysis, saying we're going to wait for the data, we're going to wait for the data, we're going to wait for the data. And I want to go and show you the two things that he's looking at, the major data he's looking at. Go to my screen here, Smay. He's looking at unemployment and he's looking at inflation. Okay. These are the two data things that he's looking at. These are the two data points he's looking at. while it's not out of control, what trend, Tshroom, what is that trend right there in unemployment?
Up to the upside.
That is an upward trend, right? That is the unemployment. Maybe it's the same it was last August, but it is still trending up. This is not a sustained downtrend. It's a sustained uptrend. What about inflation, though? What trend? I mean, if you went back here, you could say uptrend, but let's go back to last July, last August. In the same time frame, what trend is inflation under? That's a downtrend. So when he says we got to wait for this incoming data and we're not going to make moves beforehand, the data he's even currently working with is saying unemployment, while not crazy high, is trending up. And inflation, while not yet at our 2% goal, is trending down. Go off my screen here. Logic would say, hey, we're still worried about tariffs. I am not against him. I do not have a problem with the Fed saying we're worried about what tariffs will do. But what I'm sitting here saying is, and tariffs will have a negative impact on both inflation and unemployment. And one of them has been trending down and one of them has been trending up. I have more concern about the thing that's trending up. That should be the focal point of what I'm worried about. And if last August you cut rates to show the American people that you're worried about that, you are taking that into consideration, wouldn't it make more sense that you show the American people we're going to take care of the data point that gives us a bigger cause for concern? I'm going to take care of the data point that's trending up. I'm not as focused on the one that's trending down. That supports rate cuts coming. And for all we know, we do get rate cuts in June or July. It's too soon to make a call one way or the other about definitively saying where will the end of the year be with the interest rate. I don't think we're going to end the year at our current 4.5% interest rate. But I am going to say, again, as much as I've defended Jerome Powell in the past, and the fact that I don't hate Jerome Powell, I would say there were some question marks that I have about the way he handled questions. There's some question marks about the way he's handling logic. And it's not just him, it's the Fed as a whole. I look at this, and maybe I'm stupid. Maybe I'm an idiot. You guys let me know in chat. Let me know in the comments if you just think I'm as dumb as bricks. But I look at this and say, if I'm a voting member on the Fed, I'm much more worried about the trend of unemployment right now than the trend of inflation.
Yeah, so I just wanted to supply a little bit of a rebuttal to why this can still be bullish for altcoins. You know, I'm definitely somebody who's said on record, you know, quantitative easing will be bullish for altcoins. But quantitative easing can happen from other than the Fed, other central banks. And if you look at my screen, you can see the global M2 versus Bitcoin that you could got to take me off, Smay. But you see the yellow line is liquidity, is global liquidity, and that has gone up. And Bitcoin has been tracking with it as it usually does. So just because the Federal Reserve of the United States isn't cutting rates and injecting QE stimulus doesn't necessarily mean that we're going down or even sideways, because there is still a set trajectory when it comes to global liquidity. And this is a chart that has been going around and people have seen this, and you've probably seen it in other different ways. But you know, that would be my rebuttal. I'm not saying that you're wrong, Tim. I'm just saying that the global liquidity picture is actually much more bullish than what folks would be led to believe just watching this live stream and hearing Jerome Powell. Now, make no mistake, the U.S. Federal Reserve is still far and away the largest supplier of liquidity, but there's other suppliers of liquidity.
Well, but let me just rebut your rebut. That chart was Bitcoin. And I just said, I think that Bitcoin is going to make a major, I think all roads lead to Bitcoin pumps. Liquidity comes in, good, I can buy more Bitcoin. Liquidity does not come in, you know what? The markets are in trouble right now. I need to protect my money. I need to protect my value. Go buy Bitcoin, right? Both roads say buy Bitcoin. Altcoins specifically, I'm not saying altcoins drop. I'm not saying altcoin bear market while Bitcoin goes up. I'm saying altcoins stagnate, or we still haven't decided, does a melt up mean slow or fast? Watch altcoins just trickle. Nothing explosive, nothing crazy until the liquidity comes back in, spiking the markets with a lot of money to spend. Again, altcoins will be continued to be viewed as risk on assets. Right now, if no liquidity comes in, I'm not saying people will dump all their stocks and their crypto. What I'm saying is they're not going to be looking to take on extra risk. liquidity comes in, there's extra money to spend, that's when you get risky. So I'm going to continue to hold my prediction. Let us know in the comments, what do you think happens? If there's no rate cuts in 2025, will crypto, that being altcoins, still have an explosive rally, or will they be stagnant? Let us know down below. That's going to wrap up our stream for today. If you guys stuck with us all the way through and you enjoyed this stream, make sure to smash that like button. We are live every single Wednesday, normally at 3 p.m. Eastern Standard Time. We usually go 3 to 4. Today was special because of the Fed. Make sure to join us every single Wednesday for our live shows as we wrap up the biggest news happening around the week and how it affects your crypto prices. By the way, our short on Bitcoin doing very well right now. We're up over $100. If you want to trade with the bros and hear from us daily, if you want to be a part of live daily Q&As and live trading daily, make sure you check out that VIP trading group in the description down below. Also, make sure you're subscribed to the channel so that you get all of our content that comes out. We are putting much more effort right now into videos that help you. 10, 15-minute long videos to help you understand the dynamics of what's happening and how to handle your portfolio so that you can make the most amount of money possible, not just right now or today, but overall over the next couple of months, years, and make sure you set yourself up for a life of wealth building through the world of investing and trading. Make sure you're subscribed and go check out the VIP trading group. Guys, we'll see you tomorrow. The video coming out same time, same place. See you next week, the rest of you. Adios.